your portfolio, one of the things you talked about is the fact that when you find some conviction somewhere, you're able to move the portfolio and tilt it towards that, and you do, when you see the opportunities, do that. Last time we spoke, the tilt was towards the mining companies. How do you look for the next 12 months? What does your portfolio tell us about your views?
Well, so we're still long the iron ore names, which include the likes of BHP and more recently Fortescue in the last quarter of last year we added that. And the reason that we've stayed long is because we think iron ore prices are probably going to be stronger for longer. They're going to stay at more elevated levels. And what gives us a conviction there is that the supply disruptions in iron ore to date have been quite large, and we think they're going to be protracted. And the other thing we learned on our recent China trip is that the steel mills over there are remarkably complacent about the prospect of that supply returning, i.e. they think it's going to return quickly. And in our view, that's not going to happen. So those steel mills are likely short iron ore. They're running down inventories, and as we've seen in recent weeks with another 10% on the iron ore price, those steel mills are going to need to get back into the market and start buying more product to support inventories and steel production. So we're still long the iron ore names. We're also, what we don't own includes some of the defensive stocks. We think the market's overpaying for some of the defensive names which have rallied very significantly post the collapse in long bond yields.
Yep.
And also some of
these
the
are infrastructure style players.
Yeah, some of the infrastructure names, also some of the more expensive property trusts, which include the likes of Goodman Group and Dexus. And indeed, that's not a reflection on the quality of the businesses at all, because they're both high quality businesses. It's just that the valuations are unsupportable.
Really sensitive to those bond yields.
Absolutely, yeah. And I think the other thing, for some of the stocks in Matt's sector, they've absolutely benefited from those collapse in long bond yields as well, because that ultra long duration, high growth names can be quite sensitive to to moves in long bonds and a much lower discount rate. So. Yep. The market said basically, if you've got free money, we'll give it to the companies growing the fastest, and that's what.
Well, it reminds me a lot of when you started over here in 2007, and you had, a situation. I mean, all of the property trusts were trading at significant premiums to NTA, and as a result, they were out just raising money. And I mean, why wouldn't they? You'd be crazy not to. So
yeah.
We're starting to see elements of that creep back into the market as well.
Just one final question. Big sector, hard to ignore. We've just come out of the Royal Commission for the banks.
Yeah.
Do they have a little bit of clean air ahead of them now? Now that that's sort of blown over?
Well,
not blown over now that it's finished?
Well, from a regulatory sense, there's perhaps more certainty, so that's a tick. But from a business perspective and an economic sense, Matt's already spoken about the difficulties with the domestic economy, and obviously the major banks are very housing related. So, we still see margin pressure. We don't see credit growth accelerating, and in fact, it's likely to continue to decelerate, but very modestly. And then cost growth as a result of regulatory impost is likely to continue to bite. So all that means for the major banks, you're probably not going to see any earnings growth in the foreseeable future.